Equities markets are taking a tumble on Tuesday. What's causing this sell-off, and can it continue? Gary Wagner of the goldforecast.com joins us today. Gary, stocks are down, S&P 500's down. What's driving the sell-off? What's happening, Gary?
Well, this sell-off didn't start today. If you look at what happened just before Labor Day, we had, I believe it was on Thursday, where the Dow went down about 1,000 points, closed down 800 points. We've had some pretty strong selling going on for the last few days. The key is this: we are seeing a recovery, but the recovery is much slower than anticipated. One. Secondly, the pandemic is still with us. So they try to open up the schools. Many people get sick. They shut down the schools. And so when you think about the microeconomies that exist off of all of these different businesses, if you shut down a college, it shuts down the restaurants these people eat at, where they buy their clothes, the books, and so forth. So I think what we're seeing is the realization that the economy is not going to recover as quick as we thought it would.
Right, but Gary, the economy never did recover beyond people's expectations. Why didn't the sell-off happen last month, or in late July when the Nasdaq hit all-time highs? Why didn't it sell off immediately after then? There must be something today that's causing this, right?
Yeah, I mean, one, you've got to look at what the dollar was doing, but I think more importantly than that, I think there was a overwhelming optimism that wasn't really realistic. It was a belief and a hope that the economy would pick up. When the actual numbers came out and they saw that it didn't, then they reacted with their pocketbooks. In other words, that's when the market started selling off. I think that the rally we saw earlier, not so much was unrealistic, but was overextended, exaggerated.
Yeah. What do you make of Tesla's move? 15% down today.
My God, down 30% since the split, below 400. I think that is one amazing stock in terms of how it's gone down so quickly. The thing is that there's a saying, a candle that burns at both ends burns twice as bright, but for half the length. Tesla was on fire. It went up dramatically at first. So anytime you see a market move up parabolic, it will usually fall parabolic. In other words, you're getting the same kind of fall as you got when it rose.
What do you think the sell-off, what kind of impact can it have on the rest of the tech sector?
Well, first of all, with Tesla, the key was that it was not accepted into the Standard & Poor's 500. That was one of the big factors that actually drove the market to lower pricing. The expectations were that it would be included as part of the S&P 500. When it came out that they didn't, of course, it sold out. Another factor with Tesla is some of the big investors, including Elon Musk's brother, dumped a lot of Tesla shares as soon as the split happened.
Yeah, Gary, you told me offline you sold shares as soon as that split happened.
The first day it went down, I sold, yes.
Yeah. So what triggered you to sell that?
I was scared. Honest to God, it was fear that it wouldn't continue to go up.
Wait a minute, Gary.
There's a gentleman named Herbert Hoyle, one of the top stock traders in the 50s. And he was interviewed and asked, how come when everybody loses money, you seem to consistently make money? He looked at the interviewer straight in the eye and he said, it's very easy. I always sell too soon. And so I think that's an adage that some investors might want to follow.
Okay, so your timing has been pretty spot on the last couple of times we talked in a few months. So I'm just going to ask you straight up right now before I talk to you again in another 2 weeks and ask you what you sold off 2 weeks before. What are you scared about right now?
Well, right now I'm looking at gold and silvers finding a base. It might not hold, but we have gold futures up between $9 and $12 today. We have spot up roughly $8 to $10, and that is with extreme dollar strength. And that, to me, shows the resilience and the buying power right now.
Okay. Now, let's talk about unemployment and the economy. You wrote an interesting report yesterday, and you talked about how Labor Day has kind of lost its meaning given what's happened this year. Can you elaborate?
Well, it's not so much lost its meaning. It has a different implication. It's a much more somber event. I mean, first of all, for those that are gainfully employed, Labor Day is a day to be thankful, almost like a Thanksgiving. Don't take for granted that you're employed. But more than that is that we need to have real empathy for those that have lost their jobs, because even though we had the unemployment rate tick down, the alarming news to me was that there's approximately 3.9 million jobs that are coming out of the workplace that will not come back. So that means that there's millions of employees that either have to retrain, change vocation, or really make a pivot or a shift. And so it puts Labor Day in a very, very somber tone to me. It's one to be thankful if you're gainfully employed. And as I put in my article, do a random act of kindness if you are lucky enough to be employed to those that aren't, because it's important right now in this kind of an environment that those that have help those that don't. And that's the somber tone.
Yeah, jobs numbers came out last week, and the unemployment rate has dropped from 10% to 8% now. How do you fit this into the context of an economic recovery? You just mentioned at the beginning of the interview that the economic recovery is slow and sluggish. Is this improvement at all welcoming news to you, or does it not matter in the grand scheme of things?
In the grand scheme of things, it definitely matters. There's a caveat to that. And the interesting thing is, yes, unemployment has gone down. But when you're starting near zero, in other words, when you have 30 million Americans that have lost their jobs, and now some of them are coming back, it is great news. But those numbers are deceiving in that there are still a huge part of the workforce out of work. At the height of the pandemic, I think we had 30 million Americans out of work. We're somewhere around 10 to 15 million now. So we've seen a great improvement, but we are certainly not near the pre-pandemic days that occurred, in mid-March. That's when the world changed.
Are we still a long ways away, you think?
That's a question that the medical science can answer better than us. In other words, when there is a vaccine, because that's the key. What we're finding is that anytime we loosen restrictions, whether it's statewide, whether it's countywide, or in Canada also, you get a flare-up of new COVID-19 cases. The cases haven't gone down that much. They're still growing. The pace is slowing. So there's only two ways that that's going to resolve itself. Either it's going to work itself through the system without a vaccine, where people become immune because they get it and build their own antibodies, or a vaccine is produced. Now, when that happens is something that I'm not able to tell you. Right now, they're looking at the possibility of the end of the year. If that does happen, we would see a quicker recovery than if a vaccine is made available, say, mid next year. The key is going to be a vaccine.
Gary, a lot of analysts talk about the vaccine and the vaccine's effects on the markets, but the assumption here, correct me if I'm wrong, but the assumption here is that everybody's going to take it. A lot of people don't want to take the vaccine. And so do you think the impact of a vaccine is overstated?
I do not. I think that if there are those that aren't going to take the vaccine, I believe, and I could be wrong, that's going to be a minority of the people and not a majority. It doesn't make sense if there's something that keeps you from getting a very terrible illness and catching this virus, and the efficacy has been proven. In other words, it's safe and it works. Why wouldn't you take it?
Okay. My next question is about the relationship between unemployment and inflation. The Phillips curve is an economic theory that states there's an inverse relationship. We've seen unemployment come down, and so according to the Phillips curve, inflation should pick up. Would you subscribe to this theory? Can we see the CPI pick up again?
Well, it makes sense on paper. In other words, if unemployment goes up, that means that there are less expendable dollars from those people who are working, spending money, paying bills, buying groceries and such. When you have a high unemployment rate, you should have an uptick in inflation. The reason that the Fed came out last week and said that we're raising our target from 2% and letting it run a little hot is because they have a dual mandate, maximum employment and low inflation. Right now, what they said is we want to shift our focus to the employment part of the equation rather than the inflation part. We'll deal with the inflation later, but let's get people employed. And I think that that's what we'll see.
So just from the Fed, a couple of weeks ago, we spoke and you had predicted that at the Jackson Hole meeting that they would address their old mandate of targeting inflation. And sure enough, they have changed the way they're going to be targeting inflation now from a hard target of 2% to an average of 2%. So you were right in the sense that they did change their mandate somewhat. Were you surprised by how they were changing this mandate?
Here's the thing. I was not surprised at how they were changing their mandate. What I was surprised at was the investment community's reaction to the news, because many of us expected to see gold really take off on that news. It did not. It did the exact opposite, but it did a day later. Does that mean there was a knee-jerk reaction when the news first came out and it took a day to be absorbed? That I can't answer. But I can tell you that many of us analysts expected that. And in fact, I think it was the president of the Kansas City Central Bank said, I wouldn't be alarmed unless inflation ran to 3% for a year or more. To give you an idea of the wide swath they're willing to let inflation run to, it's all about employment, because without getting people gainfully employed, nothing works. You can't have a recovery.
Just a few more questions before we talk about gold and silver. Something that's been on everybody's minds following Jackson Hole, they had a slightly less dovish stance or tone as usual. Can you expect the Federal Reserve to raise rates anytime in the foreseeable future?
Personally, no. No, I think Jerome Powell in his keynote speech said to the effect, and I'm greatly paraphrasing, that he expects interest rates to stay near zero for a long time. And he spoke about it like it's going to be years rather than months. He also said that they're not going to be so quick to pull the trigger if they see these upticks in inflation and raise rates. I think that they made the mistake last time in 2008 during the recovery of ramping interest back up too quickly. And they're not going to make that mistake twice. So I think we will see interest rates remain low for some time to come.
What economic data are you looking forward to in the coming week or two?
Well, we just had the big data. We had the jobs report. We had a lot of data come out. We're now out of the summer. We're into the next month. Of course, it's going to be the jobs report at the end of the month. We have various reports throughout, but the biggest news that we're going to be watching, of course, is going to be at the end of the month, the jobs report and what's going on with the election. Because depending on the outcome of the presidential election, which is getting closer and closer, that could really rattle the markets. And so we'll have to see kind of how that plays out.
So on gold now, you were telling us about a base. What's going on with prices right now? Why aren't we seeing a breakout above $2,000 again? Should that even happen right now?
I think that it's going to form a base in this area, and I do think it will challenge and close above 2,000 at some point in time. Might be the end of this year, might be the beginning of next. I'm not looking for that to happen overnight, but when you look at today's activity, and I believe this is being aired tomorrow, but on the day after Labor Day, we saw dollar strength gain about 0.7%, and gold and silver both moved up in the futures and the cash market. That tells me that buyers are stepping back into the markets and buying gold, they're buying silver. It is now longer a risk-on environment as it was, say, a month ago. And so they're looking at the safe haven assets. The only safety right now is dollars and the precious metals.
Gary, we asked the question, what's it going to take for gold to go higher a lot on the show? So I'm going to ask you this. What would it take for gold to go lower?
A very, very strong risk-on market environment. In other words, if we had last week before the fall, we had the S&P and the NASDAQ both go to all-time record highs. If we see a strong, vibrant equities market, that would take gold lower. Could take gold lower, I should say. That's really the major factor most investors are looking at, because when you look at your portfolio, where are you going to put your dollars? And if you've got equities moving, you will forsake the safe havens over the risk-on asset class. We're seeing the opposite of that right now.
Could you see equities heading much higher after the sell-off that we've been seeing in the last couple of days?
At some point, it will find some sort of support, but I don't know where that is. I don't know how long this sell-off will last.
Finally, how do you feel about silver right now?
I like it. Silver has outperformed gold on the way up. It's been the percentage gainer. On the way down, it's had the greatest percentage drawdown. It is a lot more volatile than gold. It has a lot more opportunity than gold. However, it has tremendous price swings. So it's not for the meek, so to speak. It is a very volatile metal.
The gold miners have had a good year to date, but just in the last month, the last 4 weeks, the GDX ETF has underperformed the S&P 500. Is this due to gold's base that you were talking about, or are people just taking their money out of gold miners after the run-up we had in the summer?
Well, the mining stocks are an odd kind of group, because not only do you have to have a good sense for where gold and silver are going, but each mine has different production costs. Each mine has different strategies and how much they pay their people. There's different costs involved. So if you're looking at a gold stock, what does it cost them to get an ounce out of the ground? And that differs from mine to mine. And so for that reason, I believe there are some that will do very well, some that might not do as well. Nugget right now looks like it's moving back up, but that took a big hit. It went up past 100 and then dropped like a rock, but there's some leverage in there. I do like GOLD and GDX right now.
Okay. Gary, thanks for your updates as usual. Great thoughts. Thanks for coming on the show today.
My pleasure as always.
And thank you for watching Kitco News. Stay tuned for much more.